There's this one question that just obsesses every single investor, whether you're just starting out or you've been doing this for years. When is the right time to buy? We're all searching for that perfect golden moment to jump in. But what if I told you the secret isn't about finding the right moment at all? What if the real key to success is something completely different? So today, let's unpack that.
And you've probably heard this one right. It's a fantastic piece of advice, often credited to the legendary Warren Buffett. But let's be real for a second. It also kind of gives you that little knot in your stomach, doesn't it? It's that tiny voice in the back of your head whispering, yeah, but what if today is the absolute worst possible day to invest?
And look, that fear, it's totally real. It can be paralyzing. The fear of putting your money in right before a huge market crash, of buying at the very top, of just watching your hard-earned cash, poof, disappear. So the real question is, how do we get past that anxiety and actually get our money working for us?
Well, first things first, we've got to bust a huge, and I mean huge, myth. It's this idea of the perfect moment. This belief that you or I or anyone can successfully and consistently predict what the market's going to do next.
The goal of investing seems so simple on paper, right? Buy low, sell high. That's the dream. But the reality is, well, it's just chaos. Trying to consistently guess these peaks and valleys isn't just difficult. For most people, it's basically a statistical impossibility. Seriously, even the pros with their supercomputers and armies of analysts can't do it reliably.
Okay, so look at this. This is where it gets fascinating because it shows the massive gap between what we plan to do and what we actually do. When the market is flying high, we know we should be cautious. But our emotions, that fear of missing out, it just screams at us to buy, buy, buy. And then, when the market takes a nosedive, we panic and do the exact opposite of what we should. We sell low, locking in our losses.
And this right here, this is the emotional roller coaster we're all strapped into. It starts with a little bit of disbelief, right? That grows into enthusiasm, and then, boom, you're euphoric at the very top. But then, as things start to turn, denial kicks in. That's followed by fear, and finally, total despair right at the bottom. This cycle just repeats and repeats, and if you don't recognize it in yourself, it's a trap that will absolutely wreck your returns. So, if trying to perfectly time the market is a trap, what's the alternative? Well, the solution is actually beautifully simple. It's about shifting your entire focus from timing the market to time in the market. Now, this number should stop every market timer dead in their tracks. 50%. Let that sink in. According to JP Morgan, if you were invested for 20 years, but you missed just the 10 best days of the market, your total returns would have been chopped in half. And the crazy part is, those best days are totally unpredictable. They often pop up right after the worst days. So by trying to dodge the dips, you almost guarantee you'll miss the biggest bounces. And this chart, it shows you exactly what happens because of that behavior. Year after year, the Dalbar study finds that the average investor makes way, way less than the market itself. Look at that gap. They're leaving half their potential money on the table. And why? It's not because they're bad at picking stocks. It's because they have bad timing, jumping in and out based on fear and greed. We're basically shooting ourselves in the foot. So let's just make this crystal clear, okay? The crucial takeaway is this. Your success as an investor has way less to do with when you get in and almost everything to do with how long you stay in. It's a game of patience and endurance, not a game of prediction.
Okay, so we get it. Staying in the market is key. But how do we actually do that in the real world? How do we build a system that protects us from our own worst emotional impulses? Well, there's a simple but incredibly powerful strategy for that.
It's called dollar cost averaging, or DCA for short. And the idea is just dead simple. You invest the same amount of money on a regular schedule, say $200 on the first of every single month, no matter what the market is doing. Market's up, you invest. Market's down, you invest. It's completely automatic. And this is the magic of how it works. It's actually really cool. When prices go down, that fixed $200 of yours automatically buys more shares. And when prices are high, that same $200 buys you fewer shares. So you're naturally buying more when things are on sale without ever having to overthink it. And the benefits of doing this, they're huge. First off, you take all that emotional stress right out of the equation. Your discipline becomes totally automated. You are guaranteed to be in the market to catch those critical rebound days we talked about. And really, it just simplifies everything, turning wealth building into a calm, simple, and repeatable habit. All right, but this brings up a really common question, right?
What if you get a big chunk of cash all at once? Maybe it's a bonus from work or an inheritance. Should you invest it all in one go, or should you spread it out over time using DCA?
So here's the deal, and it's a real trade-off. On paper, since the market generally goes up over time, investing a lump sum right away has historically given better returns about 2/3 of the time. But, and this is a really big but, it comes with a huge emotional risk. Imagine you invest it all right before a 30% crash. The psychological pain of that can be so intense that it might cause you to panic and sell at the absolute worst moment. DCA, on the other hand, while it might return a little less on average, is just so much safer for your sanity.
So what's the bottom line here? It's this. Forget the spreadsheets for a second. The best investment strategy isn't the one that looks the best on paper. It's the one you can actually stick with through thick and thin without freaking out. And for pretty much all of us, that makes DCA the hands-down winner.
So as we bring this all together, the message becomes super clear. Your ultimate advantage in investing doesn't come from having a crystal ball or some complicated prediction software. So let's just recap the big ideas, the things you absolutely need to remember. First, stop trying to predict the market. It's a losing game. Second, realize that your greatest assets, your biggest advantages, are time and patience. Third, use a simple tool like dollar cost averaging to automate the whole process and take your emotions out of it. And finally, the most important takeaway of all, your real superpower as an investor isn't genius, it's discipline.
When you boil it all down, it really comes to this simple but powerful equation. So stop asking, when is the perfect time to invest? The only question that really matters is, how are you going to start investing regularly and with discipline starting today?